What is up, YouTube? I'm Ace Palomero, South Texas Realtor, proud son of the Rio Grande Valley, and black coffee drinker. And no, just because I drink my coffee black does not mean I'm a sociopath. I looked it up. Today, we're going to talk about U.S. Treasuries, how they affect the housing market, and why if you are a potential home buyer, why you should care. Let's get this rolling. What is a U.S. Treasury? It's an investment or type of investment issued by the U.S. government, basically a loan to the government. You loan money to the government, and in return, you earn money on the interest. Basically, it's budget friendly. You can buy in increments of $100, and it's generally considered a low risk or even risk free investment. And I'll talk a little bit more about that later. You have bonds, you have notes, and you have bills. Bonds have the longest maturities, 20 years or 30 years. They also pay a fixed interest rate every 6 months. And they have lower yields than stocks typically, but in return for this, they offer more stability and more liquidity. Notes are like your short-term, intermediate term treasuries. They mature in 2, 3, 5, 7, or 10 years. They also pay fixed rates every 6 months. And then your bills are your shortest terms. They mature in 4 weeks to 1 year. They don't pay fixed interest rates, and they're sold at a discount rate to their face value. Now, if you've been paying attention or been like keeping up with, I guess, anything related to the U.S. economy, you've probably seen the headlines that are saying that the 10-year U.S. Treasury is at a near 15-year high. I believe it's 4.693% as of Monday, October 2. Now, once again, the U.S. Treasuries are considered a risk-free investment, and this is because they're backed by the U.S. government. Like, think about it like this. If over a 10-year period, if the rate of return for a risk-free investment is higher compared to another investment, like you as an investor considering, why would you not go for the risk-free one, right? Basically, what's more risky for an investor or a bank or a lender, right? Lending money to like just a random person or the U.S. government. I want to point out that, the last time the 10-year was at the 10-year Treasury yields were at this level 15 years ago was 2007, right? What happened in 2007 and I guess subsequently 2008? Housing market crash and the great financial crisis. One thing that I guess investors and economists tend to agree on is that fixed rate mortgages tend to follow or be tied to the 10-year Treasury yields. So basically, whether the 10-year goes up or down, so does the fixed rate mortgages. And I'm going to throw up on this side the 10-year yield or 10-year U.S. Treasury yield from Fred Economic Data, and you can see that the 10-year started going up in March 2022. For looking at just past 2 years, what else went up in March 2022? Mortgage rates. While we're talking about U.S. Treasury yields, we might as well talk about the yield curve inversion. So normally, like the longer term for like a loan or a bond, it means you'll have a higher rate or higher yield, right? And think about it like this. If you're lending money to somebody for a longer period of time, you're going to want to ask for a higher interest rate. Because for you as a lender, the longer that term is, the riskier it is for you. For example, a 30-year mortgage will likely have a higher interest rate than a 10-year mortgage. Normally a 10-year U.S. Treasury should have a higher yield than a 7-year or a 5-year and a 2-year. And right now, or I guess if we go back to 2022, if we're looking at the 10-year versus the 2-year, the yield curve actually inverted. It looks like April, and flipped back to normal, and then it inverted again in July, and it stayed inverted since. And let me reiterate, this is not normal. That's why they call it inverted yield curve. And why the 10-year to 2-year? Like, why are we comparing them? Because that's just what investors have historically looked at as a reliable indicator of a recession. According to U.S. News, I believe I've mentioned this like in a previous video, but an inverted yield curve has accurately foreshadowed all 10 recessions since 1955. At least if we're looking at data from the Federal Bank of San Francisco, even though there was a false positive in the 60s. So we have the rising yields on the 10-year Treasury. We have an inverted yield curve, looking at 10-year versus 2-year Treasury yields anyway, since July of last year. And last year, we also had 2 consecutive quarters of negative GDP growth. Now, before, when things made more sense, recessions were typically defined as 2 consecutive quarters of negative GDP growth. But apparently we can just change the definition of words arbitrarily as long as we throw in the right buzzwords and key phrases like based on a holistic look at the data. Like, honestly, in my opinion, by the time the government deigns to announce a recession, we're probably going to be like knee deep or waist deep in it. Just my opinion. During recessions, like everything comes down, whether it's production, tax revenue, wages, prices. This includes home prices and home values. So if we enter or officially enter a recession and home values drop, like what's going to happen to people who are forced to sell? And they could be forced to sell because of job loss, or they got a new job in a new town, they have to move, or whether that new job is also promotion, right? You get a promotion, like, and it pays you exponentially more. Like, why would you not take that promotion and move? Or divorce, or let's say work from home is ending and you have to move back. Every year there's forced selling. So if we enter a recession and home values drop, like what's going to happen to these sellers? Like hopefully they have enough equity in their current homes. Because if you don't have enough equity as a seller and you have to sell, there's a chance you could be forced to have to bring money to the closing table as a seller. And that's not a situation you want to be in as a seller. I'm gonna go ahead and throw the house price index for both the U.S. as a whole and for the McAllen Edinburg Mission MSA on this side of the screen, just so y'all can see how steep that incline is regarding like the price increase. In case you can't see it there, basically the gray bars they indicate U.S. recessions, right? And like that little blip right there for like 2020, that's not a real recession. But you can see that the price increase, like even for like my area, for the Greater McAllen area, that's really steep, and for house prices. And I don't think median income has gone up at that same rate. Now, like, as a realtor, as a real estate agent, I don't want to see a recession. If we really enter, like, in a recession, it's announced officially, less people will be buying and selling real estate. Also, the price points for each property will drop. That's bad for me financially. The reason why I'm talking about it is because I don't want, like, any potential buyers to think that the run up in prices, especially in the past like 3 years, is normal. basically, one of the main points for this video and honestly this channel, at least at the moment, is just to preach a little bit of caution for would-be home buyers and would-be investors, especially if you're like a first-time home buyer, first-time investor. Like, it was me, and once again, this is not financial advice or even specific real estate advice, because I'm a realtor, but I'm not your realtor, not yet anyway, right? But if I were to buy a house for my primary residence, or let's say we're buying a house together, right? In this scenario, let's assume that we're married, we got a little one on the way, you're like 5 months pregnant, and we have to buy a house, right? Because we just don't want to live in our little apartment anymore, and we need the space. We can't move in with either of the parents because, let's say, the in-laws don't get along, right? Checklist for me, number one, is that whatever we rent it for, or whatever the monthly is for the house, and this includes taxes, insurance, and probably the HOA fee, because we're probably going to be getting it in a new neighborhood. That monthly is what we could also potentially rent it out for if we had to move out of the area. The second checklist would be that we can more than comfortably afford that monthly payment. Once again, that monthly is not just the principal and interest. That would also include, at least for me when I'm counting it all up, the taxes, insurance, and HOA fees. Also, I want to throw in that 1 to 4% annually, the 1 to 4% of the total price, for house maintenance costs, right? And the third checklist is that I would say both of us, but honestly, if we're married, probably gonna be you making the final decision. You have to absolutely love it. I guess no second thoughts. Man, I hope that didn't come off as sexist, but look, I mean, I've been an agent, I guess a part-time agent until recently anyway, for 2 years, and I mean, usually if your clients are a married couple, it's the missus, it's the wife who has the final say. And well, we're just assuming that in that previous scenario. But yeah, guys, if you're a home buyer right now, if you can more than comfortably afford that monthly payment and you love the house, why not, I guess, right? Just make sure you don't have any, if you have any kind of last minute reservations before you sign anything, you should iron that out. But yeah, if you can comfortably afford the house and you're going to be there for a long time, yeah, I guess. But in general, just because we're in uncertain and even unprecedented economic times, it's best to err, at least in my opinion, on the side of caution. But other than that, if you found anything in this video informative or entertaining, hit that subscribe button. Bye.